we still have some people rolling in. So I'm going to give it another minute, and then we'll get things kicked off here. So I'd say a couple more minutes, and then we'll get started. And I think today's presentation probably take about 30 minutes of your time, and then we'll open it up for Q&A at the end as well. So this session is also being recorded for any of those still rolling in. That will be available later after we get the recording. We'll redistribute it as well as the slide deck. So give it another minute and allow some other people to log in here, and then we'll get things started. Okay, we're going to get things kicked off. So welcome everyone to our first quarterly market update of 2023. My name is Ryan Staton. I'm a managing partner and director of planning here at StatonWalsh. We appreciate your time today. What we'd like to discuss is just kind of what happened in the fourth quarter and over the course of the year, last year in 2022. So we'll do a market recap as well as some forward-looking items and things to be optimistic for, things to watch out for, and then also some investor guidance as you navigate through 2023 and beyond. So for those who have attended our presentations previously, know that I always like to start things off on a lighter note and usually with some kind of meme or GIF. But today, I'd like to use this picture. And I think most of us, I mean, if you have children or if you've ever been to a 5-year-old soccer game, what happens typically on the field is very much like the way investors participate in capital markets. And so what ends up happening in that 5-year-old soccer game is someone kicks the ball, everyone on the field runs in one direction and they chase after the ball. And then they run somewhere else. And there's always, what I thought was funny about this picture is there's always that kid in the background, just kind of standing there looking at everyone thinking, what the heck is going on? Like, what's happening here? And this is really good symbolism. I think a great analogy for the way that a lot of us participate or view the markets. A lot of us get caught chasing the ball. And you know, some of us are beneficiaries of that and others maybe not so much. Some of us are this person in the back, really just trying to figure out, like, what the heck is going on? What am I doing here? You know, what should I be doing next? I don't know. So I'm just going to go over here and just kind of kick dirt around. The point of today's presentation is really unpack all this and kind of unpack this frame of mind and figure out, is it working? What's working for investors and what's not working for investors? But to this analogy, there's been a lot of following the crowd. And how we know that is we get data periodically on what are called fund flows. So this is a representation of how institutional and retail investors are taking their money and moving it from one type of fund to another. And so what we saw, especially towards the latter part of last year, was a heavy amount of fund flows into money markets and cash-like vehicles. And that essentially is a reaction to what was happening in the markets at that particular point in time. It was actually probably more of a reaction of what had already happened earlier in the year. And interestingly enough, what we saw is a lot of people gravitating or moving towards cash. But what actually happened in terms of performance towards the end of the year is that some of the areas where people were moving away from were actually the best performing asset classes during that time of the year. But what you're seeing here is essentially there is a much larger movement to cash. I think that is an indication that consumers and investors lack confidence in what's happening right now. But we're going to talk a little bit about that and why this approach may or may not make sense depending on your individual circumstances. So let's rewind and start with what happened last year. So at the end of 2022, we look at a lot of the major indices, and you'll see the list of them there on the left-hand side, but the S&P 500, Dow Jones Industrial, and NASDAQ Composite, some represented indexes for international developed markets, emerging markets, and then the U.S. bond index. And so what you'll see there is a lot of negative numbers on the screen, not a lot of positives from an index perspective last year. We'll break down the indexes and what happened with different sectors of the market here in a minute. But what you can see is that every index was negative in some way, even the bond index, which I think traditionally bonds and equity markets should react opposite of each other. They should have an inverse relationship. And last year was one of the first years in a really, really long time that we saw equity markets and bond markets decline in many cases by double digits. And so a very rare event and very rare outcomes. But what we saw is that even conservative investors, let's use the 60-40 portfolio, 60% equity, 40% fixed income. In that example, that person actually lost as much money in many cases as all equity investors in certain parts of the market. And so it created an interesting environment. There's a lot of different reasons why. We all know now that inflationary pressures, rapidly rising interest rates as a result of that were a big part of that transition and really that drawdown, not just in the equity markets, but as well as in the fixed income markets. And so, this chart is a representation of things that happened last year. The bright spot or the silver lining was the Dow Jones Industrial Index actually was down just shy of 7% in comparison to the rest of the market, outperformed. And there were a couple different reasons why, but one in particular, one specifically, some areas of the market like industrials and some consumer discretionary actually performed relatively well in a concentrated way. So there were concentrated pieces of the market that actually had pretty good or positive performance last year, but there were a lot of others that did not. And so that really drove major index performance in 2022. In some ways, there's a lot to unpack within each one of these individual indexes, and what we anticipate moving forward will be directly related to some other factors that we'll kind of unpack here throughout the course of the presentation. So diving a little bit deeper on that performance, we talk about individual asset classes. So all of them are listed off to the right here. Commodities, growth stocks, small caps, so U.S. small companies, the S&P 500, which many of us may be familiar with, value stocks, treasuries, different types of bonds, and then the international markets. And so what you'll see here is that there's never really a clear winner every single year. This breaks out year-to-date returns for 22, 1 month, 3 months, 6 months, and then we get a little farther out on the curve as far as time horizon. And what you'll see is that last year, the bright spot, if we want to look at one asset class that did really well, was commodities. Commodities has kind of been a punching bag for the previous, several years, and you can see here even in the 10-year total return, it has a cumulative negative return during that time period. And so, while it did really well last year, traditionally in the sense of the recent history, it has not really been a favorable asset class. And so, why do we show you all these boxes on the screen? I think it does a really good job of portraying that in specific periods of time, there's always going to be some kind of cycle or cyclical nature to the markets, and not just the equity market as a whole, but what lies beneath, which is a bunch of different asset classes. You'll see U.S. real estate, for example, not favorable last year. U.S. growth, again, not favorable last year, a pretty big downturn. But historically speaking, both of those asset classes have performed fairly well. U.S. growth over the last 10 years actually being the top performer. And so this is a visual representation of ultimately why diversification is important. There is never going to be one clear winner. It's almost impossible to predict. If you had asked someone at the beginning of 2022 if they felt that commodities were going to be the best performing asset class in the market, I don't know that many people would have had that answer, would have agreed with that. But, such is the way that the market plays out. What we're seeing now, back to my original example of following the crowd, is that many people are starting to gravitate towards these assets that did outperform. And we're going to talk a little bit later about why, we would suggest a little bit more hesitation on that and try not to necessarily chase returns that have already happened, but more importantly, try to anticipate, what might happen in the future. Going down another layer, we can really see here the different sectors, and this is representative of the previous slide. The best performing sector last year was energy. You'll see a lot of others didn't perform so well. Some that were not a surprise: communication services and technology, and some of the other segments of the market that took a pretty big hit, specifically because some companies within those sectors took some pretty big hits as well. And we'll talk about some of the individual stock performance that happened in the fourth quarter and what is driving, broader index performance as well. But, the one bright spot was energy, utilities, a very distant second, and every other sector of the market finished in negative territory for 2022. So let's talk about some of the stocks and in those different sectors, and ones that did really well and some that didn't. And so on the left-hand column there, you have the December prices and December price returns, and in the middle, the year to date. And what you'll see is that some had really good months in December, but didn't really redeem themselves for a year to date. Others added to a pretty big year for themselves. So you see Campbell Soup here in the bottom, which is the consumer defensive stock, had a really good year last year. Not a surprise. Typically in a inflationary and an environment where consumers have recessionary fears, we see that consumer defensive and in some cases utilities and commodities and others will follow suit. Not always the case, but in this case, it makes sense to us that we see a packaged foods company having a good year in a seemingly recessionary environment. The reason being, even in a recession, we all have to eat. So there were some bright spots. There were some bright spots as far as sectors individually within the sectors, but the month of December for some equities was pretty good. For some, it was really bad. And so a lot of these, one in particular, Tesla, made the news quite a bit towards the end of the year. But what you can see is that December was a really bad month that attributed to a really bad year. One exception to that here in the oil and gas world, but financial services, a lot of the consumer cyclical took a pretty big hit. Again, that aligns very well with what consumer sentiment is, that travel, resorts and casinos, you'll see here, Caesars Entertainment, and even, specialty items, auto manufacturers, falling into the consumer cyclical category, we're not in favor and may not be in favor currently. Now, the market is cycling through stuff with autos, especially as far as increased prices, but there's also increased rates now. So we may see, because that can be a rate sensitive sector of the market, may see some normalization in car prices. So the day of getting a deal could be back here in the very near future. But more importantly, in the context of the market, the past year for much of the consumer cyclical segment of the market was a pretty rough one. And that aligns pretty well with the crowd and what sentiment is and what people believe is coming, and potentially a recession here in at some point in 2023. So quick recap of the market. Now let's talk a little bit about some of the economic data that exists out there. And so this chart shows core inflation, U.S. inflation, and the targeted federal funds rate, kind of the upper limit of that. And so right now, inflation peaked and is starting to, we're seeing waning inflation. So we're seeing a pullback of inflationary data every month that comes out. The number has been reduced slightly. Obviously positive news for the market and for the economy. I think most importantly for consumers. That's not necessarily going to be the case in all segments of the market. If you're buying, you're going to the grocery store right now, it might not feel like there's a pullback in inflation because certain items are actually spiking in price. But there will be a direct relationship, and it's been said over and over again by Fed Chair Jerome Powell, that there will be a direct relationship between inflation and what the targeted Fed funds rate actually ends up being. And so if we continue to see inflation retreat in some way, that will also give us some more clarity throughout the course of this year as to when we will see a peaking of interest rates and then ultimately a reversal of Fed policy in the opposite direction to getting closer to their long-term Fed funds target rate, which has been stated to be around 2.5%. Currently today, it's 4.5% on the upper limit. However, reduced inflation will help with that. Will help push that back down to what everyone anticipates as long-term inflation under 3%. Something else that many have been keeping a close eye on is the unemployment rate, and more importantly, U.S. labor force participation rate. So one of the things that if you pay attention to the news cycle that gets a lot of attention right now is there's a lot of jobs available, and companies are having a hard time filling them with qualified candidates. A large part of that is labor force participation. So as you can see from this chart, we had a massive reduction in labor force participation. And, a couple percentage points doesn't seem like a lot, but it's a lot of people relative to eligible working bodies in the United States. And so a couple percent or a 3% plus percent drop in this is millions and millions of employees. And so what we're seeing is that there was some normalization to that, but we're not quite back to our pre-pandemic levels of labor force participation. And so a couple of reasons why. Some left the workforce and don't anticipate coming back. Some have been more intentional about their reintroduction into the labor force. But ultimately, these two numbers together tell a story of there is very low unemployment rate currently, but there are also a lot of available jobs, and we're not keeping pace with the number of people we need to fill those jobs. And so ultimately what we want to see and what economists want to see is that labor force participation increase and that we can get to a place where we're at least close to, if not equaling our pre-pandemic levels. I think that will create some efficiency in our economy. Obviously, when goods and services need to be produced, in many ways you have to have people to produce them, and so that's something that has been has caused to some degree the supply side of inflation to drag out. Is that not being able to get goods or services out to people in a timely fashion just because there's not a labor force to deliver that. As that begins to normalize, I think the true unemployment rate will become clear, as well as what employers will have to do in the sense of being competitive in a highly competitive employment environment, and whether that's in the form of wage growth or being more creative with compensation packages. All that remains to be seen. But this is something that in many ways the labor force participation piece, in many ways, is going to need to increase, I think, to provide more efficiency and more clarity in the market. Something else that is, highly publicized and gets a lot of attention is, with rising interest rates came rising mortgage rates. As of the date of this chart, 30-year mortgage rate was 6.33, 15, 5.5. One thing that's interesting too, when we look at median home prices, and so sales of new houses, so new builds versus sales of existing homes, and we look at the national averages, those, I think, not to anyone's surprise, have increased pretty significantly over the past couple of years, even pre-COVID into today. And so where those sit currently, the average sale price for a new build is at $471,200, and the average sale price on an existing home that's being sold to someone else is $370,700. $370,700. And so the question becomes, how will sustained or higher mortgage rates affect the prices? Conventional wisdom tells us that the higher interest rates are, that pricing will be compressed in some way. And I know we have some real estate professionals on this call, and so I won't, we don't have to get into the philosophical reasons of why that's not happening today, but there's a lot of things influencing why home prices have not mirrored the rapid increase in mortgage rates. And I think to some degree, this will be an item that will need to play out through the rest of this year. This is something we actually will keep a close eye on, because housing and homes and the purchase, the buying and selling of them is very interest rate sensitive, historically speaking. And so we haven't seen we're starting to see some decline. You could see that on existing homes. New builds have kind of been, teetering back and forth. Price has gone up, it's gone down, it's gone back up again. It's starting to come back down. The question is, will this trend continue? Will we start to see a compression of home prices throughout the rest of this year, and how will that affect the markets and the economy as a whole? It's an indication of what's happening out there in the real world, not just in the context of equity markets. And so this is something that is interesting. This specifically, the existing home median sale price, and if that will continue to decline and normalize in some way, or if that is kind of a new normal, and that having a median sale price for homes is going to continue and kind of maintain at current levels. Like I said, a lot of this is contingent on the interest rate environment. And so it's no secret that interest rates have gone up pretty significantly over the past 12 months. And when we look at what the rates are based on the duration, what we're seeing is what's called an inverted yield curve. So what does that mean? Essentially, an inverted yield curve means that shorter duration bonds are actually paying more than longer duration bonds, which is not traditional. Typically, the more amount of time you're giving someone to pay you back, typically the higher the interest rate, because there's a risk associated with that. Versus a shorter duration where you're going to get your money in the next month, 3 months, 6 months, a year. Right now, because of the increased Fed funds rate and the speed at which that happened, what we're seeing is that in the treasury markets especially, shorter duration is actually paying more than longer duration. From an investor perspective, what that's done is reframe the conversation about how should bonds be positioned in my portfolio. Should I be taking a longer term view when I can get, instead of getting 3.97% on a 30-year, maybe I should just do a 6-month or a 1 year and get 4.7. That seems like a better deal for me. And so in many ways, there's a disintermediation away from long-term bonds, moving money away from that and putting money in shorter-term, fixed income securities right now. A lot of this is also in your short-term interest rates, especially, are tied to certain debt vehicles. And so, we talked about mortgages, we talked about the car market. Consumer lending as well will play a part in this. If anyone that has a credit card has probably gotten a statement in the last 6 months that stated that their variable APR rate is significantly higher than it was a year ago. And so we're seeing gradual increases still in these rates. At some point when the Federal Reserve decides to reverse course and normalize their Fed funds rate, maybe back to a place of the previously stated 2.5%, there will also be a normalized yield curve, which will create some waves in the market in the way of short duration bonds will not become as attractive and long duration may come back into favor. If interest rates are believed to be sustained at a higher level for a longer period of time, you're also going to see an increase, and you're already starting to see that on these longer yield curves or these durations that are further down the line. You're starting to see larger incremental increases in the rates, partially because if this rate hike does continue through 2023, and if the Federal Reserve says we're going to spill over into 24, then ultimately, these will need to keep pace. So inverted yield curves in some cases can also be an indication of a recession, which is why they get a ton of attention and why many are monitoring these this data pretty closely. Something else that we're seeing in the market is uneasy consumers. So this chart is a representation of a percentage of sales change in different segments of the market. And so what we're seeing is that during 2022, grocery sales increased, food and beverage increased, U.S. retail sales increased some, but what we saw is department store went down, U.S. autos, really small incremental increase, and electronics and appliance sales were negative over the course of the year. And so this leads us to believe that in some ways, some of these consumer discretionary, going back to some of the previous slides, consumer discretionary is dropping, or consumer sentiment is declining. And so people are not spending their money the same way that they were a year ago. They're using it, instead of using it to buy electronics, appliances, and buy, fancy, cool gadgets, they're using it to pay for food, to pay for food and beverage store sales, to pay for groceries, to buy essentials from retail stores, not to necessarily buy new cars and not to spend it at your brick and mortar department store. So there's been a shift for sure. A lot of this is consumers assuming that we are either already in a recession or that a recession is coming in the very near future. So it's something that will directly relate to market behaviors for many consumers. How they spend their money and how they view the world ultimately translates to how investors make decisions and how they redeploy their capital. So something of note and something to keep an eye on, as we get through the first quarter of this year, another data point that we'll keep a pretty close eye on. So a natural question is, if we're in the middle of a recession or a recession is coming, what does that mean for my portfolio? This chart, while cluttered, is a representation of a couple different items. The green line represents the S&P 500 return. The purple line represents unemployment, and those gray shaded bars are the periods of recession that we're experiencing at that time. The black line, the vertical bar there, is a representation of the low point in the market. What you'll see, without diving into the intricacies of every chart here and why things happened in those times, the point of me showing this to you is to portray that there are periods of time when we're in the middle of a recession and we don't reach, we get past the recession and we've not yet met our low point in the market. There are other periods of time where we hit our low point at the very beginning of a recession and the market goes up immediately after that. There are times where throughout a recession, the market as a whole, so when we look at the S&P 500, actually goes up during a recession. It seems counterintuitive, but to briefly summarize this chart, I think the point to remember is that none of this has any direct correlation to one. Like there is no direct relationship between the two. History has told us that things can happen for no rhyme or reason other than that the market is a forward-looking vehicle that is designed to project what they think is going to happen over the next year or 18 months. In some cases, even in shorter durations. But the common misconception with the market is that it is a reactionary vehicle. Data comes out, it looks bleak, everyone's upset, and we all exit stage left and say, you know what, the market's going to go down because this happened. And then what happens from time to time is it actually goes up. There were some examples day to day of this last year, but this has happened many times in history. And so, in some cases, the two are not related. Us going into a recession as from a U.S. economical perspective does not necessarily mean that the market is going to go down in a significant way. In some cases, it could mean that the market declines that have already happened are in anticipation of that recession happening right now or in the near future. And so because it is a forward-looking and a predicting vehicle, a leading vehicle, it's hard to say that just because a recession is possible or imminent, that the market will react in a negative way. Most portfolio managers and economists and those that we follow and speak with on a regular basis believe that a lot of that has already been priced in, meaning that the big declines of last year were anticipation of the bad stuff that we're now talking about today. And so the biggest takeaway from this is try to disassociate the idea of market performance and economic environment as it exists today. Market performance is an interpretation of previous data that is, and interpreting how that will affect the future, not so much how is that going to affect us right now in January of 2023. So another question we get a lot from some clients and friends is like, should I just wait it out? Should I just should I just follow the crowd, go to a money market, go to cash, and should I just kind of wait out this thing until there's some clarity on what direction we're actually headed? And so my answer to that is typically, my blanket answer to that is usually no, being honest. But let's look at the data. Why does it not make sense necessarily to sit on the sidelines in a market environment? And we've gone through many charts in previous presentations on the cost of sitting out or sitting on the sidelines, missing good days in the market. All of that aside, I think the biggest topic that we've all talked about is inflation over the past year. And inflation, headline inflation, is certainly much higher in the 2020s so far. But previously, sitting in cash or being more conservative with money, you could get away with it in some ways because you were keeping up with certain types of inflation. For example, medical inflation in the 1990s was 5.3. A 6-month CD was paying 5.4. So dollar for dollar, you were keeping pace. Right now, in the 2020s, excluding recent history, which is a rapid spike of interest rates, so far in the 2020s, a 6-month CD yield is paid about 0.4%. Education inflation during that same time frame has been 2.1, medical inflation 2.6, housing inflation 4.8, and overall headline inflation 4.9. So the argument of if I participate in the market, there's a potential I can lose money. The idea of inflation is that the spending power of your dollar diminishes over time because the cost of items go up. And so if you're sitting in cash earning a minimal amount, and so let's use it in the context of today's world, you're sitting in cash earning 4%, but inflation is 6%, you're still losing money. You don't see it, you don't feel it, but when you go to the grocery store and something is 10% more expensive, that makes a difference. Now, in the context of investing, this is really pivotal for retirement, investors that are in the middle of retirement, because assets that you hold in retirement they're the ones paying your income. The assets that you own generate your income, not your hard work, your blood, sweat, tears. And so having money sitting on the sidelines in many cases, and even if you're not retired, in many cases, while in the short term can be painful, long term can have a damaging effect to what your ability to accumulate wealth, and more importantly, your ability to maintain pace with just everyday inflation that's happening. And so I think to some degree, high interest rates are not necessarily here to stay in the context of today's market. And so this chart is a great representation of, if I wait it out, not only am I trying to make the mistake of timing the market, but I'm also losing money in the process. So something to consider. That doesn't mean that some consumers shouldn't hold cash. There are still reasons to have cash, by the way. But having too much cash or having half of your portfolio value in cash doesn't necessarily make sense in the broader financial planning conversation of, I need my money to keep pace with inflation, because that's my hurdle rate now. That's what I have to beat just to have my same dollar be worth $1 in 10 years. This is a chart we use pretty frequently. It just goes over the intra-year returns. Why did I include this? 2022 wasn't a great year. We've established that. We've talked about it. I think we can put a pin in that conversation for the rest of the presentation. The reason I included this was I had a conversation in our fourth quarter webinar about intra-year declines, and interestingly enough, the chart at that point mirrored this 25%. So the market was down at its low point at the time we gave this presentation last time. From that point forward, from the third quarter through the fourth quarter, the market actually jumped back up, and I say this kind of tongue-in-cheek, but it jumped back up to negative 19%, silver lining. So why is that important? Well, if you got spooked at negative 25 and you moved, going back to the previous slide, you moved your money to cash, you missed that run up. It doesn't seem significant to only lose 19% towards 25, but that is a return that you will never get back in your portfolio, because now you've taken money out of an investment and you've bought back in at a higher rate. So let's say you did get back into the market at the beginning of this year, that 6% is gone, and what that 6% would have been compounded over time is also gone. So this is a visual representation of something we refer to as lost opportunity cost. This also stresses the importance of maintaining your posture. And if you're going to be invested, it is almost always better to take less risk if that's what's going to be motivating for you to stay invested, than to move money in and out of the market during various points in time. And the reason, not just in 22, but if we look back historically, there are a lot of years on here where there's red dots in double-digit territory where the market finishes in double-digit positive territory. And so if you miss those days in the market, or you got spooked and you cashed out, that is rate of return that you'll never get back. And quite honestly, it's hard to do this. It's hard to figure out when these things are going to happen. In many cases, it's happened almost every year where the market, the S&P 500 specifically, has been negative. But the annual returns were positive in 32 of the last 43 that are depicted here on this chart. So, important takeaway, I think it's the bigger value to investing is getting invested and staying invested, not trying to figure out when's the right time to pull money out of the market. Now, there could be good times to reallocate or to position differently, but getting in and out of the market just hasn't served individual investors well. So let's talk about our investment outlook. Where are we now? So this is, if you subscribe to our weekly market updates, these emails come out every week. Our most recent weekly market update had this data in it. So year to date, things look positive. There's been a decline in the 10-year note. There's been a decline in interest rates on mortgages as well. So there's some positive news, and the year has gotten off to a fast start. Now, the past couple of days haven't been so favorable, but at the end of the day, we've kicked off the year in a positive way. And so a lot of that is anticipation of what's to come. So why are we optimistic about any of this? Like, if you turn on the news, you probably aren't going to get a lot of positives, but let's talk really quick about 3 areas that we feel give us reason for optimism. Number one is waning inflation. I think anytime inflation comes down, that's good for consumers, that's good for the economy, and that that could ultimately be good for the market. Lower inflation rates, ability to spend money is good for corporate earnings. It's good for, for businesses. It's good in a lot of different ways. And so if that continues to pull back at the rate that it is, we think that's a good thing for markets. The job market resiliency piece. So the job market has been relatively resilient, even though they can't, many employers can't find people to fill positions. That hasn't come to a head yet. It's something that could potentially be a reason to not be optimistic at some point in the future. But right now, the job market is showing tremendous resiliency with the ability to keep up with supply side pressures and get products and services out there to consumers. It's certainly not perfect. It's not at its efficient, at its most efficient point, but it is a reason for optimism. We think if we can turn a corner there and start getting people back into the labor force, that will be another positive for the market. The last one is China's abandonment of the zero COVID policy. China has been virtually shut down in many ways for the past couple of years. And so an abandonment of this policy ultimately leads to a lot of pent-up demand potentially being released into the market. That's good for international markets. That's good for a lot of different sectors. It's good for the United States. At the end of the day, if they maintain this posture and they have officially abandoned this and don't try to revert back to it, this will be good for the world economy. China is a large country. They're a large consumer. And so if this were to continue, and if it does, we believe it will, we feel like that's a reason to be optimistic about the future, especially from a consumer and consumption of goods perspective. Some other positives, sort of, is that the average investor got better. So this is a chart that we traditionally use, and in previous quarters, we use the 20-year numbers. And last presentation we gave, the average investor had gone from like 2.6% rate of return to 3.6, which is a huge uptick. What we did here is we focused on the past 10 years just to visualize what has happened in the market and how have average investors kept pace with that. And so what you'll see is that the average investor's rate of return during this period of time, the average equity investor's rate of return, I should say, jumped from 3.6 to 8.7, which is really good. That's a really good rate of return for many investors over a 10-year annualized period. And so, many would look at this and say, investors are doing awesome. The retail brokerage world is working. All that's great. But here's the problem. The S&P 500 during that same period of time almost returned almost double that number. So there is still a discrepancy here, a rather big discrepancy, actually. And so what does this tell us? It tells us that even though the rate of return increased significantly for the average investor, they're still not keeping pace with someone who just bought an S&P 500 fund and just kind of let it ride for the past 10 years. And so that's telling. And obviously, this is not inclusive of what happened last year in 2022. My guess is if we threw that data into the mix, that this chart would look very different. I imagine all of these would trim down the percentages a little bit. But the point being is that the average investor got better, but actually in the same vein, they got worse. So the gap has widened, and really it's a behavior gap ultimately. What we've seen over the past few years is a more volatile market in a more extreme way. And so equity markets move day to day faster and in bigger percentages than probably ever, and more so than I can remember. I mean, when I started in this business, seeing a swing of 1% to 2% during a day was like a big deal. Now it feels like it's a regular occurrence, like it just happens all the time. And so what's my point here? Equity market returns have been good over the past 10 years, but we're still lagging. As an investor community, we're still lagging behind the 8 ball. And so how do we close that gap? I think the big thing is going to be discipline, diversification, and a couple different factors I'll talk about in another slide. But the goal here is we need to close that gap, whether it's us as a financial advisor or us as a community of consumers, a community of investors. figuring out better ways to educate ourselves and do what we can to close this gap so that we can keep pace and that ultimately we can achieve the investment returns that we want and need over time. And by the way, during that same period of time, this closely mirrored a 40-60 portfolio. So an equity investor mirrored a portfolio of a 40% equity, 60% bond portfolio. So a lot more probably to unpack there, but I think the gist of it is average investor is still lagging behind even just a major indice or just picking an asset class and kind of sticking with it. So what do we need to watch this year? Inflation report. There's an expectation of continued decline, but it's not always guaranteed. So we'll need to keep a close eye on that and make sure that expectations are playing out on a month-to-month basis. Corporate earnings is another big one. The biggest question is how will corporate earnings hold up amid a tighter monetary policy? Corporate earnings were very resilient last year. So far this year, it's been mixed, been some good and some bad. This will be something to keep a very, very close eye on how does inflation, how does tightened monetary policy, how do all these things that are going on affect corporate earnings? Because ultimately, corporate earnings trickle down to us as investors, especially for some of the companies that you're investing in. That can affect dividend rates, it can affect the price of the stock. And so that's something that we'll keep a much closer eye on. The other question is how will rate-sensitive sectors perform? One example of that is housing. If rates continue to rise, which is anticipated, will mortgage rates match that, and will home prices normalize to a level where home sales can still be efficient in a market where we have a higher interest rate environment? Ultimately, that's going to come down to reduced prices. If that happens, then we see housing sales normalizing. If that doesn't happen, then we have a lot of question marks about that specific sector of the market. And there are others as well, but housing is one that I think gets the most publicity in today's world. The job market will be another ability to fill those positions. I kind of already talked about that in a few different areas. One that we didn't talk about specifically is credit markets. Credit markets are interesting because despite higher rates last year, there have still been relatively low rates of default and bankruptcy. And so the anticipation is that in a higher rate environment, the credit markets tend to see some volatility in the sense that there may be some bankruptcies or may be some default. If we have a sustained level of high interest rates and companies are forced to issue credit at a higher rate, this may be something that we see that snowballs in the future. It's not necessarily a crisis, but it's something to keep an eye on. It's not a credit market crisis of the 2008, 2009. We're not talking about anything drastic like that. But it is something to keep an eye on because that can have a direct effect on companies, and ultimately it goes up the ladder to effect on share prices. So what do you do as an investor? All that being said, a lot of information, a lot of stuff thrown at you here today. What can you do? High level, remain disciplined and focus on your long-term financial plan. Not necessarily just long-term investment strategy, but what is the planning around that particular investment asset? It's important to note that many of the strongest market gains have followed periods of pain for investors. And so while it doesn't feel like there may be a light at the tunnel, that reversal may come sooner than you think. The other piece I would argue, and for those that manage themselves or those that work with a financial advisor, is really focusing on resilience in your portfolio. I mentioned this in a previous presentation. It still applies today. You have to diversify and resist the idea of chasing the crowd. Chasing the crowd creates poor investor behavior and translates to poor investor returns. We've seen that, and even in a market where the S&P 500 over the past 10 years has done awesome, the average investor is still not keeping pace. Part of that has to do with keeping up with the Joneses and crowd chasing. So what do? We have to resist that urge. The other piece is focusing on quality. The past couple of years has been this explosive growth for certain companies in the market. 2022 was kind of a reversion to the mean. Everything kind of went backwards for a lot of those companies. think the Teslas, the Netflix, the technology companies, some that are benefactors of COVID. Now we're seeing a little bit of a reversal. So what is our message? Focus on quality, focus on companies with strong balance sheets, consistent earnings, and that pay and grow dividends over time. Translation to asset classes that we talked about, large cap value stocks are one. There are other funds and other investments out there that can accomplish this. This is a point of conversation that I would suggest everyone have with, whoever they're working with to help manage their money, or, conversation we're already having with clients of ours. All right. And then consider, and I say this specifically, an appropriate risk mitigation strategies. There's going to be a lot of fear mongering out there in the market. Do not get sucked into the idea that there is anything is guaranteed. I'll say that high level. There are different types of investments and products out there that can help mitigate risk. But the key is that they have to be appropriate to you as an investor. That doesn't mean that they're bad products. It doesn't mean that they're bad design, that they're bad strategies. But they have to be appropriate for what your goals are. And more importantly, they have to fit into what the long-term financial plan is. If you stick to that, if you stick to those rules and you keep those guardrails in place, you'll continue to invest in a way that that I think would be appropriate for your individual circumstances. But it's something to closely evaluate. Don't get overly concerned or overly excited about products or people selling certainty, because it happens every time there's a recessionary environment, high inflation. You see it on TV. All of a sudden, gold and silver commercials go bonkers, and you're getting do this, do that, protect your nest egg, buy this product. Build a plan, stick to the plan, and find product strategies and services that are related and work within the context of that plan, not just because they're a shiny new object. So with that, I'll transition it into questions. I went a little bit over, so I'll kind of open the floor, allow everyone to participate where they want. Feel free to use the chat feature, or you can use the Q&A as well. We're going to stick around here until 1. So feel free to fire away with any questions. All right, looks like I got one directly here in the chat from someone. What is your overall view of the market in 2023? So I'd say at a high level, we're generally optimistic. I think that we feel like 2023 should be a relatively good year. Relative to last year, we think it's going to be a positive year. Now, what that translates to in rates of return, I don't pretend to have a crystal ball or to pretend that I know exactly what's going to happen, but I think there's a lot of reasons to be optimistic. There's a lot of reasons that you should still exist and participate in the market. And I think that, if your risk tolerance is followed, or if you have appropriate conversations about risk appetite and risk tolerance, I think building those portfolios become much easier, and participating in the market becomes much easier. So summarizing, relatively optimistic. Someone asked, when is Devin allowed to speak? Devin's allowed to speak whenever he wants. I appreciate the question, though. Maybe we should start holding.
I let Ryan be the star of the show.
All right. Well, we'll stick around here for a couple more minutes, see if anyone has any questions. Oh, somebody wants thoughts from Devin now. They want your outlook.
Like Ryan said, like it's optimistic. There's a lot of ways that we can think that, when we talk about financial news, it's negativity everywhere. We had a meeting earlier with somebody, and just we're getting constantly, they're selling financial propaganda. So I think the biggest thing is just staying optimistic, staying disciplined in what you're doing. And like Ryan said, don't follow the ball, the soccer ball, wherever else is doing.
I love that soccer ball analogy, by the way. I didn't come up with it, just in case anyone was wondering. I did steal it, so credit to the folks that shared that with me. But I do think it's a fair analogy, and it actually plays pretty well in an environment like right now. But like I said, we'll stick around if anyone has any other questions. I see some people dropping off, so hopefully that means we did a good job. Hopefully everyone enjoyed it. For those that are still here, you will get a link to the video, a repeat, as well as slide deck. So feel free to use that however you'd like. But we appreciate you guys taking time out of your day, of course, to spend Thursday afternoon with us, and always appreciative of your questions and your participation. So with that, we'll let everyone get back to their day, and we'll see you next time.